Hey everybody, and welcome back to H Invests. Today we're going through Metastock. Boy, has this been a ride. So we've seen Metastock fall incredibly heavily. Number of reasons. Apple's iOS tracking and privacy changes. We're going to talk about that. Inflation and recession risks slowing down that ad revenue growth in Q1, which was actually the quarter where their stock went up. We can see that here. They gave low revenue guidance, so that's something we're going to have to watch going forward. They missed their earnings per share estimates by 4%, and also they are ramping their R&D up on their Metaverse projects, their reality labs, changing the way they advertise and trying to put R&D in to say, how can we adapt to the iOS changes? And obviously, that goes under operating expenses, which also hurts bottom line growth. So there's a number of things going on there. One thing you've got to look at is when Facebook's share price fell, their earnings were on the 3rd of Feb, right? And at this time, the market was getting absolutely hammered. It's still getting hammered at the time of recording this video. But in that period, in January, it was down 12.3% from the 3rd of January to the 3rd of Feb when Facebook gave their results. And around that period, if you didn't have good year-end results, your stock was getting absolutely slaughtered. Exactly the same with Q1, right? Look at Netflix, look at Amazon, Alphabet. These stocks have been absolutely slaughtered. Obviously, Facebook's been no exception. They have done well in Q1. That's pushed their share price up a bit. But I mean, look at it in reality, way below that 350 to 380 range. One interesting thing to look at with Facebook stock is it is incredibly popular among the super investors. It's very lovely and very convenient that for a lot of these big investors managing money, it then becomes public information on a 13F filing, and that's released. It has to be released 90 days after the end of the quarter. And as you can see, of these roughly 80 super investors that Data Roma tracks, 30 of them owned Facebook right before the end of Q1 2022. And you can see the Q1 results are starting to come in for the holdings. They're not finished yet. They're going to be fully updated on the 15th of May. But of the ones that have come through early, none of these 30 super investors look like they're going to be selling Facebook. There was a number of them that were selling quite heavily in Q4, but obviously the average price paid in Q4 was $336, way above where the share price is now. So that 336 comes from the average of basically these 3 months. So you don't know exactly when they sold in the quarter, you just know that they sold at some point in that quarter, right? So it's positive to see no super investors dumping their shares just yet. To see this kind of fall on such a big stock, it could bear the question, is this an incredible opportunity? Particularly with Facebook working towards the Metaverse, right? You can see still very sterling growth from a company like Facebook, right? You wouldn't expect anything less. However, slowing growth going forward and massively reduced free cash flow next year. We're going to talk about that in this video. Value-wise, their ratios are pretty much the lowest that they've ever been. Price to turnover of 5, EV to EBITDA of 10. That's very low for a company like Facebook. PE about 15, 16 in that range. EV to free cash flow, very low as well. What we're going to do now is we're going to dive into a valuation. We're going to look at analyst estimates and how Facebook are valued based off different rates of earnings per share growth and discount rates. And then we're going to talk a bit more about the business, and then we're going to dive into the wonders of the Metaverse. I hope you guys enjoy this video. Hey everybody, so here we are with Meta's DCF. So you can see return over growth going forwards. I'm pretty surprised with these analyst estimates, particularly because, Facebook, they're saying in Q2 that revenue growth is going to be flat, when they compare the quarter to the Q2 in 2021. So to say 11%, okay, I understand that is now materially much slower. So that's why this is down at 11%. I'm still surprised that it's that high, to be fair with you. Maybe there's going to be more analysts revising their estimates down. Big drop in free cash flow. A lot of this is due to the margins contracting, which is much higher R&D both on the metaverse, all of that VR and AR reality lab stuff that Facebook is spending on, and also extra spending on their core business, trying to work out how to get through the iOS changes, and also doing updates to Facebook and Instagram. So after this drop in free cash flow, we're seeing quite a big rebound. Like when you average this out, when you actually go like average free cash flow growth, that's 10%. When you do the compound average growth rate from here to here, it's only 5.5% going forward. And then all of a sudden you think, like that is pretty damn low. Going forward then for the next 2 years, I put in 8 to 9% growth and did this terminal value on 54 billion. Particularly because if the analyst's saying, okay, we're growing at an average of about 14% turnover growth here, I still think their margins are going to be slightly lower. So obviously that's not going to convert into as much free cash flow. So that's why I chose 50,000, 54,000 for these 2 final years. Facebook, their net cash, you can actually add that on to the enterprise value to get a slightly higher market cap. And these are the shares that's outstanding. They're probably going to continue to buy a little bit of shares, a little bit more shares. Oh, here's the diagram. It's just come up on the screen. Yeah, they're probably going to continue to buy back a few more shares, but of course their free cash flow priority is to go to Reality Labs and invest in that going forward. So with these assumptions, a 10% discount rate, 4% long run growth rate, we're looking at a fair value of $266 a share. Which isn't high compared to where Facebook have been trading, but there is quite a bit of upside on the current share price. If we look at the earnings per share, of course, like Facebook is at a historically low PE, so we've got that to work with. You can see that the earnings per share average numbers, they're kind of similar to what the analysts expect to see for turnover. There is quite a wide range. I don't know if I've put that on here. No, I haven't. There is quite a wide range of analyst expectations. Like some think that this next year in terms of earnings per share is absolutely going to suck. Others think that the turnover, others think that the EPS is going to grow incredibly quickly. So there's a wide divergence. So that's a bit of a risk when building this EPS model. You can see we're getting a very similar price based off average PE of 22.5, which is about this level in between these 2 grey lines. So we're looking in this level, which you can see that's pretty much average. Obviously Meta's traded at a premium in the big kind of tech stock market boom in 2020, early 2021. I don't think it's going to be trading up in the 30 to 35 range, particularly with negative sentiment. I don't think the big Meta hype is going to come for a couple of years yet. But I do think that's going to help to drive the PE up. So I would say, a PE in the range of 20 to 25 is reasonable. And that gives us a fair value, very similar to our discounted cash flow valuation. If we compare at different growth rates, then you can see, if you're bullish and you say the EPS is going to grow at 12% a year on average for the next 5 years, Facebook are going to do quite well, particularly if you're comfortable with 25 times earnings. I don't think the market's going to get to 25 times earnings for Meta in the next 5 years. I'm very bearish on the market as a whole. Facebook carries a lot of systemic risk because it's highly correlated to the NASDAQ and behaves very similarly to the NASDAQ. So if we're in a big bear market, there's not going to be much to protect Meta. And of course, if they have a bad quarter, they're the kind of stock that gets absolutely slaughtered. On the most conservative side, PE of 20 with 4% earnings per share growth still gives us 10% upside on the current share price, which I think is quite positive. The conclusion from these valuations is that Meta does look pretty cheap. There are risks to that, but on the whole, it looks like an undervalued company. Okay, so let's talk about Meta as an investment opportunity. And yes, I'm fully aware that I have been calling Meta Facebook for most of this video. Obviously, that was their name since the IPOs in 2012 until about 6 months ago, and the majority of their revenue still comes from Facebook.com, hence the lack of catching on with the new name. So you've got an interesting opportunity here. You've got the majority of their business being a very mature, stable cash cow, the ad revenue being generated through Facebook and Instagram, but then you've got exciting, innovative opportunities with Facebook Reality Labs and with Meta. And the really good thing here is that Facebook, they have the cash from here. Like, look at this cash flow they generated, 39 billion in free cash flow last year, right? and Facebook don't pay a dividend. They are buying back a few of their shares, which is great for shareholders anyway, and it's great when you have a cheap share price, which we do at the moment. They're barely paying off any debt because they barely have any debt. So a lot of this free cash flow can be, chucked into new investment projects, which is just amazing. And this could be the dream team for a company. Meta, they currently have 4 new headsets they're bringing out. We're going to talk about that much more in the Metaverse portion of this video. But it looks like very promising stuff. If we look at the core business, 97% of it is still advertising. So you can see total revenue 27.9, and then total ad revenue is 27. So only 3% of their revenue is the Reality Labs revenue, which is basically all of their Metaverse stuff. 695 million, it sounds like a lot. It's just not a lot for Facebook, right? Like when you're buying this company, you're buying the certainty of the cash flow from the core business, and you're buying the uncertainty that they could be the leader in the Metaverse going forward, right? If we look at revenue by user geography, this is a little bit concerning because their revenue in their mature markets, Europe, US, Canada, that's pretty much stagnated. I think that overall, when you look at overall revenue, it's likely to continue to grow single digits in the near future, but that's because they're still getting substantial revenue growth in Asia. One other thing I should mention is that when you're comparing both this and both this, always bear in mind that when you're comparing it to the last quarter, particularly when it's Q1, Q4 is going to have artificially high revenue because, hey, it's Christmas time, right? So everyone is buying their kids headsets for Christmas. All advertising, all companies want to advertise because it's the heaviest consumer spending season. So Facebook always get a revenue boost with their ad revenue in Q4. So the best thing to do is compare Q1 2022 to Q1 of 2021. And you can see some level of growth here. But the growth is certainly slowing down. The company is maturing. They have, if we just go over to here, daily active users, their daily active users, as I said, like it's pretty much stagnating in Europe and the US and Canada, still growing heavily in Asia Pacific and the rest of the world. But they can gain much higher average revenue per user from these developed markets, right? And what is worrying is that if Facebook are being materially impacted by Apple's iOS change, right? And that could hurt their average revenue per user, at least for a time. And if it doesn't hurt that average revenue per user, they're going to have to spend significantly on R&D just to try and find an alternative solution, right? To just give you the basics on the iOS change, basically it's changes that Apple have implemented, which are going to make it much harder for Facebook to track their users, right, when they're signed into their Facebook account on Apple. So what that means is the ads are going to be less tailored, then they're going to get less clicks, they're going to be less effective, and then obviously businesses are going to pay less for that, right? Because the ads are ultimately bringing in less revenue for the business, so Facebook's ad premiums are going to fall. That's the long story short on that. And yeah, they're projecting that 10 billion in ad revenue sales are going to be lost, which is significant for the company. I think the economic moat remains. The network effect of having the largest network in the world of social media users, and I think the switching costs are there, particularly with Instagram, where people have spent a significant amount of time, building their profile and making it look good. I think it can be hard for people to leave social media sites like that. So I think that Facebook, they're quite sticky with their users. Even when user growth is stagnating, you can see that most people that are on Facebook, they are staying on Facebook. The churn of new users in Europe is quite low, but people that were on Facebook, they are staying on Facebook, right? This is another point with the average revenue per user. It is still quite low in Asia Pacific, where they're growing quickly when you compare that to Europe. So Facebook could probably double their revenue there, particularly when this includes, developed markets like Australia, Japan, Southeast Asia, these kind of places. But, the bulk of the revenue, again, if we look at it, it still comes from US, Europe, and Canada. So the way we're going to see this is that the core business is going to be a slow growing cash cow. And the advantage that Facebook have got is they're going to have all that free cash flow, which they're not doing much else with because they don't pay a dividend. They virtually have no debtors to pay off, right? So that free cash flow is purely the companies and the shareholders, right? So I think the way they're going to do it is they're going to pivot and they're going to go all into the metaverse, right? And that is a massive double-edged sword. We're going to talk about the metaverse now because yes, they can pivot all into the metaverse, and if it works out for them, that is amazing, right? Because they're going to be the leader. If it doesn't work out for them, then you've kind of got a company that is growing incredibly slowly. I mean, obviously, Facebook's share price is going to fall because it wasn't the fast grower that it once was, right? I believe that the infrastructure and the base and the economic moat for their core business is there, but I don't think the growth is going to be as significant going forwards. So Meta's metaverse is called Horizon Worlds, right? So they've already got an established metaverse. So that's really good progress that we're seeing. We've got a lot of different companies setting up different metaverses though. And it's very, very, very early days. It's like back in the 1990s, late 1990s, when you've got all of these search engines popping up. You know, just the fact that you've moved early or that you've got a bit of investment, it means virtually nothing. The advantage that Facebook have got is that they have that money to pivot and they're going heavy in on it, right? They've changed their name from Facebook to Meta. That is the advantage they've got. Sandbox VR, they're already developing high-end hardware. Yeah, let's talk about the hardware for a minute, because when I Googled, you know, go-to hardware for the metaverse, what would you recommend as the best hardware for entering the metaverse? The Oculus Quest 2, which Facebook make, that came top. And to get such good Amazon reviews, you know, 5 stars, 86%, and also to see only 2% give 1 star with such a high sample size of reviews, that is incredibly positive. So, and it's interesting as well, because if Facebook are controlling the hardware and the software, that is going to give them really good interconnectivity, and they're not going to have the same problems of, oh, we control the software, i.e. Facebook and Instagram website, but we don't control the hardware, i.e. the Apple iPhone, therefore, you know, Apple can do X, Y, Z to us and there's nothing we can really do about it. By owning the hardware as well and having that in conjunction with the software, it's going to allow much more ease to flow between the two, and it's going to help them avoid running into the same problems that they did with the Apple iOS changes. So that's an incredibly positive thing. Some of the hardware investments, which I'm going to show you on the next slide, sound incredible. And I'm also going to talk about on the slide after that some of the scale advantages and the capital advantages that Meta have over their competitors. So here's just some very, very amazing things. Perpetual science, so they're looking at using VR to combine auditory, visual, and haptic feedback, right? And the way you're just going to feel much more immersed in the metaverse, right? What else have we got here? So tiny soft motors all over the glove. We've got hand tracking, haptic rendering. Like Facebook, not only are they investing in the metaverse platform and you know having these headsets, they're also investing in the more advanced ways for people to enter the metaverse going forward. So they're investing heavily in the software. We haven't really seen much of it come to market yet, but if it all pays off, we will see it come to market in the next few years. This is the kind of risk that I was saying in terms of their bottom line is going to be really affected going forward, because you can see their R&D as a percentage of their turnover has gone up massively in the last quarter. We're expecting that to increase significantly. It's not only the metaverse, it's also, you know, keeping that base on their conventional platforms, you know, try and stop TikTok taking over too much of their business, and also, you know, how to kind of weave around with the iOS changes. Because look, Facebook, they're a massive company, they've got significant resources, they're going to find ways around to grow their average revenue per user, even with the impact of their iOS changes. But is that going to take a significant amount of money and research to do that? Yes, of course it is, right? So we're going to expect lower bottom line growth and lower margins from Facebook going forward. Another thing to remember about this metaverse investment is that the Reality Labs, the collective investment that Meta are doing, that's still only 3% of their revenue, right? and it's not been growing particularly quickly. We can see the revenue here, 717. Okay, let's ignore Q4 2020 because it was Christmas. Let's look at last year, 534, 305, 558, and then again, this is Christmas, so 695. So there's what, like 20% growth from here to here. That's good. Imagine if they 5x their revenue growth on this, right? Then it still only becomes 15% of Facebook's revenue. That gives you an idea of how early Meta are into the metaverse. So this is a very, very long-term play. I think that the main advantage that Facebook have is that they're being incredibly proactive, and also these capital requirements, which I'm going to talk about now. Their main disadvantage, I think, is that going forward, they're pretty much going all in on VR, AR, and the metaverse. Their key advantage with this, if we compare it to a lot of other metaverse players, because they're a well-established business, huge amounts of free cash flow compared to the young startup companies, huge amounts of turnover. And yeah, Apple and Microsoft, they look like they're going to be big players in the metaverse going forward as well. Both companies generate more free cash flow than Facebook. However, they have a lot of other commitments. Both of these companies, they do pay dividends, and they also have a lot of other investments that they're making, particularly Microsoft with the Azure cloud. So again, Facebook are going in all in on this. So they're probably generating the highest amount of capital that they're then utilizing into Meta and VR. But then again, it's a big risk because it's an all-in investment. It just depends on how big you think the metaverse is going to be. I think it could be really, really big. It's just a case of how Metaverse harness that technology, how successful they're able to do it. Couple of really good ball points is that when you compare Meta to some of the smaller companies that are trying to get heavily involved in the metaverse space, Roblox and Unity, I've highlighted here, it's going to be much easier for Facebook to keep chucking capital. Why do I say that? Two reasons. So Facebook, they don't need to generate any more money to do it. They don't need to raise more equity. They've got a ridiculous amount of free cash flow to put towards it, right? And these other companies, again, they're going to have to raise more shares. They're going to have to raise more equity or raise more debt. And both are more difficult. The same way that buying back shares is good for a company when the company is trading cheaply, which is what Facebook have been doing, which is good. The same way that that's good for the company, issuing more shares when the share price is falling is bad for the company, right? And that's what Roblox and Unity are having to do. When the whole entire company is smaller and the amount that you can raise per share is smaller, you're going to have to raise a lot more shares to get that same amount of equity, which is going to dilute the existing shareholders' ownership more and more. So it's going to be very difficult for companies to do that, justify doing that. Obviously, that's what Roblox and Unity have been doing. I don't blame them because they're not highly profitable companies yet, so they have to raise more money. I'm just saying that with the stock market crashing and also credit getting tighter, interest rates going up, you know, investors probably less likely to lend money to non-profitable startup ventures in a bit of a market downturn. I think that the startup younger companies are going to have more of a tough time. That's not to say that Roblox and Unity are amazing companies. I think what they're doing is great. It's one question to say whether they're priced right at the moment. They certainly look more attractive than what they used to. However, I think that these smaller companies that don't have that same wad of free cash flow that that Meta is piling into the metaverse, they're going to have a big disadvantage with share prices crashing and credit getting tighter. It's going to be harder for them to issue more equity, harder for them to issue more debt. Systemic market risk, this is something to talk about as well. Facebook, they're quite heavily correlated with the NASDAQ. You can see the graph over the last 10 years. If we look 1 year, I've got the 1 year projections here. They're quite highly correlated with the NASDAQ. A little bit less so than other companies, other large market cap companies that are in the NASDAQ. But hey ho, what do you expect? So I'm just saying that in a big bear market, it seems that Facebook's share price is being pulled down with the NASDAQ quite a lot. We've seen a bit of resilience since the share price jumped after the good Q1 earnings. However, this is systemic risk, right? If we're in a bear market and Facebook is highly correlated with the tech side of the market, which hasn't performed very well in 2022. In fact, it's been the worst start to the year on record, and the Nasdaq has seen some of its worst months since October 2008. It does put the share price in a bit of a short-term bear trend. However, that could also mean that you can average down and get Facebook at incredibly attractive prices when it is already undervalued. So, in conclusion, am I buying Meta stroke Facebook, which is what I've been calling it for half of this video? Well, sort of. So, I've decided to buy a call option on Meta at the moment, which is not something that I usually do. I've decided to do this because it's given me good upside exposure to Facebook without using up too much of my cash position, which I'm still waiting on the sidelines to buy companies that I want to buy at incredibly attractive prices. I bought when the market and Facebook were both down on the day, which made the option a little bit cheaper. So this is the contract that I bought. It's a 185 call expiring in January 2023, which basically means in January 2023, if Facebook is trading below $185, I lose all of that premium that I paid. But it also does mean that, if Facebook goes up, it's going to mean that I am getting significant exposure to that without having to commit too much capital. So let's just say, for example, if Facebook goes up to 285, then I've got basically 10,000 worth of intrinsic value. So the call option would be worth at least $10,000, probably a bit more when you add on extrinsic value. And if the VIX is very high as well, that's going to add to that call premium. So I'll be on a really good return with that. And yeah, the break-even price at expiry is 231. So as long as Facebook is trading above 231 on or above expiry, then that call is going to make a profit. There's no guarantee that it will. I mean, the upside for me on this is that if we see a significant nosedive and my call option expires worthless, then I think it's the time to go heavily into Meta. So for instance, 4% average EPS growth with a PE of 20, implied share price $233. That doesn't give me that much upside on the average share price at the moment, but again, if Facebook falls, and particularly if it's systemic risk, right, then Facebook looks much cheaper going forward. There's much more upside there. Worst case scenario is that they don't get Meta off the ground, they don't grow at all, they're kind of in a slump, they don't grow their EPS, PE of 15, fair value of 156. I mean, there's not that much downside on the share price. And if it falls 20% more, then I think that's a good time to buy, because I don't think this scenario is likely. I think Facebook really know what they're doing with the Metaverse. It's just incredibly early to say if they're going to be the leader going forward. I hope you guys enjoyed my analysis on Meta. Please let me know any questions in the comments. Good luck with your investing, and I will see you for the next video very soon. Goodbye.